One of the most important duties facing directors is that of solvency. It's an area of internal control and monitoring that relates to both the fiduciary duty and agency theory, as we've discussed previously. So why don't we get into talking about what solvency actually is, how to recognise it, what the duties are, and probably the historical reason for why solvency is treated as such an important topic. The first point, I think, is to distinguish solvency from corporate performance. Obviously, if you're insolvent, you've got significant problems. In fact, there's been a corporate breakdown or failure. So it's a clear signal of negative performance. In fact, some would argue the worst case scenario in terms of performance. Having said that, though, it's not the be-all and end-all of performance. It's just one marker, and probably the end marker. So I wouldn't want to overemphasize that this is all you need to be aware of when you're monitoring a corporation or any organization. You need to understand what performance is for your organization and then be monitoring towards that aspect of performance. And I think that's often a little bit missing from our discussions when we talk about solvency. We just focus in on this really negative aspect. And yes, it's super important for reasons we'll go into, but it shouldn't be the be-all and end-all. We've really got to be thinking about what performance actually means. While solvency is a very important aspect of performance, it's kind of got a little bit of a counterintuitive definition. Okay, so being insolvent is not being solvent, and being solvent means you can pay your debts as and when they fall due. So notice that there's no strict test here. Being solvent is being able to pay your debts when they're due. Now, most often that will involve clear markers around your financial statements, but many times it actually won't. And it means that the definition is really quite broad and actually unclear, because we can't really say prospectively with 100% certainty a lot of the times when you'll be able to pay your debts and when you won't. So that's what causes a lot of uncertainty, right? This greyness about whether we're solvent or whether we're not. Key to remember in your mind is that it's your ability to pay your debts when they're due. I think the best way about thinking about solvency comes from understanding conceptually what's going on, and then we can move on to the technical elements from there. So why don't we do that? Why don't we have a look under the hood, see what's going on in solvency? What's the law in particular worried about here? The first thing to note about solvency in this judgment taken from Woodgate and Davis is that it's an important social purpose. Okay. This is important because the whole idea of solvency is based upon our economic, and some would even say our social system that involves corporations. So the idea of the solvency provisions is to make directors pay attention and conduct themselves or make decisions in the right way when they're going to take on debt when they can't pay it. Okay, so that's the real issue here. We see a shift in the emphasis from shareholders to creditors in terms of the interests of the company. So you can think of it like this. Corporations are in essence a nexus of contracts between the parties. Now the contract between the shareholders and the company is that the shareholders give their money, which the company can lose, and then the shareholders get any excess profits left over. In contrast, creditors supply either money or their labour or goods, and they expect to be paid in full at a future date. Now, once they can no longer be paid, that is, the debts can't be paid as and when they fall due by the corporation. Once the creditors can't be paid as per the terms of their contract, what we see is a shift that in fact the company is now starting to risk the creditors' money, not the shareholders' money. And that wasn't part of the deal. So that's that fundamental breakdown in the nature of the entire contract of the corporation. And you can have a think about what that means and what administration and liquidation does, because that's centered at realigning that contract. Given the generalized nature of the definition of solvency, it's important to go through how we determine it. And these steps set out by Palmer in the Southern Cross Interiors case give us some insight. Note, it's about the position as a whole. So you just can't look at one financial aspect of the company or even just finances. There's, for instance, the ability of the company to access other capital that becomes important as to whether they can pay their debts when they fall due. It includes a commercial reality such as selling assets. So it's just not total cash flow if you can sell an asset to pay the debts. And also the fact that it's not necessarily about payment terms strictly applied. Okay, so when debts are fall due would imply the terms of trade. But if there's a history of late payment or even, a somewhat elongated payment schedule, the law can relax when debts are actually due, because generally they would like full payment rather than partial payment, even on time. They would prefer full payment later. So what we can see is these elements introduce this whole issue of greyness when we come to determining what solvency is, or rather, when solvency should occur. This greyness with respect to solvency extends to the definition of what is included in a debt that's due and payable, and also the proof that's required. Now, here is our kind of contrasting but really important and somewhat contradictory statements. Solvency or insolvency is largely a matter of cash flow. If you have the right cash flow, that you can pay the debts, you have cash coming in before it should be going out to pay the debts, then you're solvent. However, that might not be conclusive. Okay, so we've got to look at several other factors as well. And we'll have a separate video on how we might analyse financial statements to help us make this decision. So the specific section of the Act is Section 588G, and you are guilty of breaching the section if the company is insolvent at the time of taking a debt or becomes insolvent due to taking on the debt. There were reasonable grounds to suspect insolvency, and a person aware of the grounds or a like person in a like position. So this means it's an objective test. Okay. So if a person who was a director, and the courts have said that they would expect directors to have basic financial literacy. So if someone with financial literacy would have been aware that they were solvent or approaching solvency, and you fail to take action, then you'll be guilty of breaching this section of the Act. So what are reasonable grounds for suspecting insolvency? Well, these reasonable grounds are determined by what we would expect of an ordinary competent director. Okay. Now note that it's also about the director's position, but the courts have, in the James Hardy case and others, set out that an ordinary competent director would be financially literate. Okay, so that means you have to be able to read the financial statements. Maybe not detailed aspects of classifications of things, but you have to be able to determine whether or not you're approaching an insolvent trading position or not. Are defences under Section 588H? The key point I would like for us to remember is that these are quite hard to make out. Okay, so when we have something like relying on a subordinate, you'd think, oh, well, that's pretty broad, but it actually isn't, because if the information conflicts with the subordinate's advice, right, then that won't apply. Also, if the facts of the situation conflict, then the court is going to ask, why didn't you question? Okay. If the financial statements are incorrect and there's something in there that they later see as incorrect, they're going to say, wouldn't a competent person have seen mistakes? Okay. So it becomes, in reality, quite difficult for this reliance on a subordinate, particularly over a long period of time. Over a short period of time, I think you've got a much better case that you were lied to or relied on it. But over a long period of time, it's going to be quite difficult. Notice, though, that if you're ill or if you have a leave of absence, something like that, you'll be fine during that period. Finally, we can see that even if you see it coming, if you do all you can to stop the debt, all that you reasonably can to stop the debt, you might have a defence as well. Having said that there's defences, I just want to reiterate that they can be quite difficult to actually make out in reality. As I mentioned before, there's a number of specific financial ratios and tests that you can use to help you see solvency. Here's some listed on this slide here, and we're going to spend a little bit of time in a different video actually looking at those and how to apply them and analyse them in a coherent manner on a financial statement. In addition to these financial measures of performance and signals of solvency, there's also a heck of a lot of non-financial signals of solvency. And these ones come out of a classic case, the water wheel case, involving an infamous Australian executive, John Elliott, and a particular case he was involved with where they were found guilty of insolvent trading. These non-financial signals include things like directors leaving unexpectedly, the bankers withdrawing support, not being able to get finance or either through debt or equity, creditors changing their payment terms, right? So it could be either the payment terms or your payments, your payment times lengthening. So if you're taking longer to pay people, you got to wonder, do we actually have the cash to pay them? Trading losses are of course a sign, particularly in your cash flows. Okay, your operating cash flows in particular. Are you seeing post-dated or dishonoured checks? Cash on delivery terms. You can't get financial information. Right? So if your financial information is slowing or bogged down, that might be a sense that all's not well in this particular area. And of course, one of the key things that can often catch you out are large payments that take a long time for the debtor to follow up on, particularly the government, payroll tax, group tax, sometimes GST, superannuation. And all of these payments have really quite strict requirements, and they also have onerous liabilities on the directors. You don't pay some of these things, you're liable as a director, even though you were being tricked and the company didn't do it. So it's really important to make sure that these statutory payments are actually made, because they can be one of the first ones that don't get paid when a company faces financial difficulties. In all of these, we have to think, what can a director really be expected to know or not to know? The courts have been very clear. This is from the judgment, the Commissioner of Taxation and Clark, where that it is expected that all directors can read the financial statements. Mrs. Clark claimed she signed papers with a pen in one hand and a frying pan in the other, meaning that her husband really ran the company. It also came from a time when the Corporations Act required at least 2 directors, so it was quite usual for one party in the family to be a director and the other one would in essence just be a blind director, just sitting there not really understanding what's going on, fulfilling that legal requirement. The court here found that in those instances that director was just as liable. So this comes back to it being an objective test. It wasn't about what Mrs. Clark knew or didn't know or had the ability to do or not do. It was about what would a reasonably competent director do in those circumstances. That's the test, not what you know. In summary, directors need to ensure that companies don't trade when they're insolvent. There are some very limited defences under 588H. The liability involves both criminal and civil penalties, but the biggest penalty is that the directors are personally liable for the debts incurred after the point of insolvency. So while fines can be hundreds of thousands of dollars, if you're in a big company, these debts can be worth millions of dollars. So it's by far the largest monetary liability potential that we have in the Act. The reason? Because it's the point of a fundamental breakdown in the nature of the corporation and the nature of the contract between the parties. Hopefully that gives you a little bit of an oversight of the solvency arena, and you can now look at maybe some of those technical tests that we can do to work out whether we have solvency or not.